Greg, if you're ready, let me ask you this. Would you rather do an interview format, or you just want to go over what you're seeing? I'm going to make you the presenter. Well, Stelios is
right. I'm back. Sorry. I'm back.
Okay. Well, Greg is here, and I'm going to make him the presenter.
Okay. Thank you. And sorry about that, everybody.
That's okay. Good analysis, Stel. Good job.
No problem.
Steve will be so proud of you. Hi, Grega.
How are you?
Good, buddy. How about you? You have a good weekend?
Sure. It was sunny. Finally.
Okay. Yeah. All right. So it's springtime there in Slovakia.
Yes.
Starting
starting
to warm up a little bit.
Yeah. It was about it's a very, very long winter. So.
Okay. Well, thanks for coming in to, step up with Steve down. It's your choice, Greg, of whether you just want to, do what you usually do. But if you'd like, we could, record the rest of the show in kind of an interview format. It's completely up to you.
Yeah, sure. Look, if you have any questions, of course, I'm here to answer. Maybe we can cover some these long-term charts on housing starts that I shared on Twitter and Skype this weekend.
Okay, yeah, that's some beautiful stuff. So why don't we do it kind of this way in an interview format? So I'm going to pretend you just came into the room. Hi, everybody. Grega Horvat. His reputation precedes him coming into our room. I know a lot of you people that are subscribing to ForexAnalytix notice that I bring up his wave counts a lot, and I look for compliments from what I'm seeing from Grega. I love his work. Grega, I interviewed Grega, I don't know, probably about 3 years ago when he won an award, and he's repeated that, repeated award winner on FX Street. So Grega, I know you have some things to talk about long term, but you know what? I bet a lot of people would be interested in the beginnings of your journey. We know where you are now. What was it like for you at the beginning?
I started trading Forex when I was around 19, 20 years old. And wow. I really fell into it, or I just loved the markets as soon as I heard for the first time for the Elliott wave theory. It was in the first 2 years probably. So at the start, when I was interested in the markets, immediately through Todd Gordon, I got familiar with Elliott wave principle, and I just love it. So
yeah,
it was
Todd's a very talented E-waver. Do you know if Todd really got his background like a lot of people? And I'm, a lot of people that I interview, Grega, say, even though they've developed their own style of E-waves and they see things differently than other E-wavers, most of them cut their teeth on Prechter's book. Did you ever go back and look at what Prechter did, or was the beginning really Todd?
Actually, I was inspired by Todd. Okay, but then I just watched his analysis. What is Elliott wave at the start? I just didn't know what are these ABCs, and then through his commentary, I of course realized it's Elliott wave theory, and then I googled it, and I immediately ordered 15 books, I think, from Elliott Wave International website, and I just went through a lot of charts, a lot of work from Prechter. So actually, I was really into it very deeply. So because I had an interest, so I'm not really sure if I would be in the market so deeply if there would not be Elliott wave theory. I'm just really, it's really.
It harmonized with your nature, right? And I don't know, were you always interested in geometry or math before this, and kind of how the universe works? And it was one of those great accidents that happened.
Yes, maybe, probably. I loved math very, very much in school, so maybe it has something to do with this as well. And I just love statistics. I love analysis. not just only trading, because as you know, trading, it's maybe 10% of the time, 90% of the time you will just track markets, or maybe even more, or analyze them before you.
You know what? Most people don't know that ratio, Grega. You know, I bet most people have it reversed at 90-10. So, you know, that's a pearl right here, is that, you know, you get paid to wait. And people think they're missing out by waiting, but what they're really doing is preparing themselves for more of a high probability outcome. Do you agree?
Yes. Well, a lot of people, a lot of traders are waiting to pull a trader, but to put a trigger on, but they're just waiting. During this time, I don't wait. I just analyze. I don't know when I will take a next trade. I just analyze, and through analysis, I figure out, okay, this can be my trade. This is not my trade. This is not my time. You know. So it's whole context of a process or of a trading approach probably. And if I don't analyze, I don't know what to trade actually. So analyze on the first place, it makes sense, you know. So
yeah, and you know, another pearl I got from you, and you know, I haven't heard it from too many traders, is you always know where you're wrong, but you're wide open, even though you have targets, to your targets being exceeded, and so you never cap the positive side of the trade, because even though you have a wave count, it could turn into something more significant. Is that correct?
Yes, I found this useful a lot of time in the past actually. For example, if I'm trading or want to catch a fifth wave up, and for a fifth wave based on FIP projection levels, you would probably set up your limit target, right? But there's always a chance that fifth wave will get extended, and maybe in the week or 2 or 3 weeks you will actually realize that this was not a fifth wave, it was a wave 3. Okay, so Elliott wave, it's actually based on statistics, what or probabilities, what is likely to happen next. But there's always the other side of the coin, which means it can happen something unexpected, and markets, as you know, can surprise a lot of times. So actually, if you are in a winning trade, I always also saying this or repeat this to my clients: leave your targets open, but more importantly, make sure to book some profits and pull your stops tighter. Even if I am in some kind of with the trade in my target zone for FIP levels of a fifth wave, and I think, okay, market maybe will reverse here, I will still pull my stops very tightly to the upside and will leave market a chance and to trade to be a bigger gainer. So actually, it's not that if I'm right, it's actually it's all about what market is doing, you know. So I'm just following market. It's not the market that is following me.
Beautiful. Yeah, a lot of people would prefer it that the market followed them. I've even tried a magnet on the screen to affect the candle. So you know, one other question that I've always been interested in, and I think it sets E-waivers apart. How do you know, or what makes you decide the difference between your preferred and alternate counts?
It's actually, I will always do my best to label the wave count in the direction of a trade. And I will always try to say myself, if we see a pullback from the highs, don't try to be smart and say that this is going to be a new 5-wave fall. Rather label it as a correction, no matter how far or how high the previous trend went. Okay, so because statistically speaking, there is a greater chance that this was only a temporary pullback and it will go higher, rather than a top of a new 5-wave fall that will unfold in the next in the future. So actually, I'm always trying to label my primary counts in the direction of a trade.
Okay, so the trend, and it would be the same in a bear market. You would be doing the opposite.
Yes, of course.
Okay, got it. All right, so I saw that chart you posted on Skype to the team.
Yes,
I know you have some looks that you want to share with the community, and you know, actually, I got a question on Twitter, Grega. someone was asking, well, you know, the last couple of waves turned down from certain levels, yeah, up around 2200. Why do you think it's not going to go to 2200 this time? They were asking me. I just retweeted it. So in case they're watching, buddy, what do you think? What makes you think we're going to terminate here? And it looks like kind of like a 50% correction that we've had in housing starts over this whole big recovery in equities and everything. So that really never fully recaptured the 2007 highs. It looks more like a bounce.
Yes. So actually, I noticed that reply on Twitter, but actually, as you can see, he highlighted that previous readings of housing starts was much higher before this reversal to the downside occurred. But we also have to keep in mind that the previous decline was much deeper than any previous fall. Okay, and what we have to understand that actually this housing bubble caused this financial crisis in 2008, right? So actually, banks, if you will go on a bank, you will not get the loan so easily like you did before 2008. Okay, so this is why housing starts reading is not so powerful to the upside for the last few years. It's higher, but it's not so powerful. Okay, so actually, my thinking is that because you will not get loans so easily, right? Which makes sense because banks have to be more conservative when they give you a loan. So actually, this is the reason why this housing starts is not improving so much. So I don't think that we will see readings like we did back in 1970 and 1985 and 2005. So I think that there's but the key point of this whole cycle analysis was
interest rates.
What I want to say that I'm not saying that housing starts will top out here. What I want to highlight with this chart is that if you want to go into stocks for the next 5-10 years, you will keep an eye on these housing starts data and probably wait on a decline first before you may want to look into the stock market. Because if we take a look at the past readings after each decline, which lasted from 3 to 6 years on housing starts, then after 3 to 6 years, when this housing starts bear market stop, we can see on the right Dow Jones from each swing low continued straight to the upside, right? So my thinking is that housing starts could continue higher, but if I would want to be in stocks, I will say, okay, I will not go into stocks for the next 5-10 years. I will wait what will happen with the housing starts, and once this market is lower, I will be looking for potential opportunities on stocks, because at the moment we are definitely.
It's kind of a cautionary signal for people that, you know, have their whole net worth in their 401k and stocks and everything, is that you think, you know, that the housing starts is more of an indication of maybe the market's overpriced because we had a pretty weak recovery in housing. And if we go back to the lows again, the market could be very vulnerable.
Yes, but you know, this I'm not saying that maybe stocks, even if they extend to the upside, right? It still can take time before any top or reversal will be formed. So it will not happen in a year or so. You know, this can be a very long process before we get this next cycle, and especially it can be very, very far away before next longer term opportunity in stocks could be seen. So when I'm looking for a longer term opportunities, again, important is that I don't see any opportunities longer term on stocks. So I would rather look maybe at commodities, right? Okay. Commodities are much, much lower, but there are a lot of investors who are tracking commodity index, but real commodity index is from Thomson Reuters or from Bloomberg.
Not the CRB, not the CRB.
Yes, actually CRB is also okay, but the problem with this is that it contains too much data of crude oil, right? And the crude oil
kind of like the Dixie is too heavily weighted in euro. The
Yes.
CRB is too heavily weighted in oil and maybe not enough in grains or softs.
Yes, exactly. So you have to look at some equally weighted commodity index before you can make conclusion if next commodity cycle or current commodity cycle is lower or it's higher, right? So actually I have this chart here. Actually I have it here on a trading view. Just a second. Equally weighted commodity index. Okay, so this chart, this price data contains equally weighted crude oil, gold, soybean, corn, wheat, coffee, sugar, and different agricultures as well, right? So, yes. Technically speaking, what we see here, right, is on the left we had a very strong drop in 2008. Then we had nice recovery, and this recovery, right, from 2009 to 2011 was interestingly very strongly correlated with the stock market. But probably I think it was correlated because they done QE for the first time back then, right? And they probably put a lot of money into different markets. Investors got really excited, but for the next few years, actually, probably QE.
Yeah, that was 1900 gold, Grega, up there.
Yes. So actually.
Why are you laughing?
Yes, because you know.
1900 gold. Yeah, go ahead.
Actually, what I see is that now from 2011 and especially from 2014, when stock market accelerated to the upside, we can see that commodities actually are moving to the downside. They are not following stock market very good, actually, right? So I think that the next longer term opportunity will not be in stocks, okay, because we are probably too high. I think that commodities could be a very interesting place to look, okay. But again, from an Elliott wave perspective, there can be room for more downside here to make completed 5-wave fall in a wave C. I also see this as a potential triangle formation, maybe here for a wave 4. So actually,
do you do any, Grega, when you come up with like, is it just coincidence that your C is showing up next year? Do you do any work in time that gives you an idea of when cycle might begin to bottom out?
Actually, as you know, I made this cycle analysis for stocks as well here, which suggests then.
So you tie in cycle work with your Elliott stuff.
Yes, I try to make a combination and a different correlation to one context from different markets, right? So I see room for stocks maybe for another 3 or 4 years, 2021, maybe 2022. If someone is interested to see more detailed analysis on this, I think we discussed with Steve on Friday or Thursday, I don't know, so they can check recording. So actually, I see room for more upside here on stocks, which is matching perfectly with another leg down here, which is missing on commodities. Okay, so for the next 2 years, 3 years, maybe we get another leg down. And actually, as you know, I'm also expecting another leg up on dollar index, which is, again, makes perfect sense. If commodities are moving to the downside, then dollar could get actually stronger, right? So for the longer term speaking, I think that commodities, maybe even if my wave count is wrong, I think that the next cycle could be actually to the upside in the next 5 to 10 years. So I think there are here much better opportunities here rather than on stocks.
Okay. Well, your telescopic view is even is from the Hubble telescope. Stelios was using his little binoculars from Greece, and you're using the Hubble here. So, continue. So there you go.
Yes, and actually, I have here this chart of wheat, right? Notice that here, 1970s, this was a stock market top, okay? And then after stock market top, we have seen a move, extremely sharp move to the upside in wheat. Here was in 1980s, around there was a stock market low. As you know, market then broke to the upside very sharply, and actually
yeah, 82.
Yes.
82. I remember. I think the Dow was 600, and then
Yes.
and then it finally broke out over 1,000. That's how old I am.
And you can see the wheat actually was trading down since then. So
Yeah.
actually, there was plenty of time similar correlation. And actually, in 2018, now we can see, as we know, in January, stocks were trading at the highs, and look where wheat is, right? And this is just one commodity. So the next cycle, 5 to 10 years, I believe, will be to the upside on these commodities. And also, it's very similar picture here on corn. We are also trading at the lows, not anywhere near the highs. Okay? So
well, the Chinese, Greg, have seen your charts because they're big stockpilers of wheat now, huge.
Okay.
So they're preparing for the next cycle. They're, you know, Chinese thinking's a lot more longer term. They think in terms of 50, 100 years instead of 6 months or the next election.
Yes, actually, if any listeners now of this webinar are interested in these longer term charts, they can find them. Just let me give you a link here. Macrotrends.net. If you will maybe share on chat, Dale.
Okay, yeah, that's okay.
So actually, they can you can find here data since 1929 or even more. So I think it's a very useful data, especially because for longer term investment, you need to have more information as possible. So going longer or going more back in time, it can be really more helpful, I guess. So macrotrends.net, if anyone is interested.
Very nice of you to give them credit. Okay. They got it.
Okay, so actually here is soybean, also similar situation. Stock market fell here after 1972, around there. We have seen a strong break to the upside in soybean. Stock market crashed here in 1987, I think. We have seen then move to the upside, strong rise on soybean. Similar thing in 2000. Then here you can see positive correlation with stocks. This is probably an exemption, probably because of QE, I believe. And now, more importantly, in 2018, stock market is at a high. Soybean is trading at these potential lower levels, from where I think we could see a next important 5 to 10 year cycle to the upside.
Are the grains your best representative of, you know, correlated moves with the stock market, or are there other groups like energy and metals?
You know, energy, metals are can act very differently. Crude oil as well. If you take a look at crude oil, you will see now we are in sharp rise, but those grains are not, right? So crude oil, I think, has a more stronger correlation with stocks because of economy as a whole, probably.
Okay. How about and what precious metals to the dollar?
I think that precious metals could also be very interesting opportunities longer term, but still, I think that there is more room for more weakness. Maybe in line with this commodity index that I showed you.
It's early next year. Yeah.
Yes, actually, if I go to gold chart, you will actually see that technically it's also not bullish. Just a second.
It wants to remain a mystery. There we go.
Okay, so here's weekly. So actually, you can see here that we are rising, but are not rising any strong here. Actually, bullish legs are looking weak. So I think that sooner or later resistance can be seen, and we'll see another leg to the downside. then again, with this is matching quite nicely with this commodity index, and also maybe with stocks where I actually expect push to the upside, back to new all-time highs for the next few years. As I said, cycle analysis suggests that we will be looking for trading higher for till 2022 maybe, right? So during this time, until then, we could see gold moving to the downside still. So actually, I would be really careful with metals here. I would probably wait much lower levels for longer term opportunities. Same thing.
The super people, Grega, that are also do Elliott. Some are looking for 4,200 in the S&P before it tops. Do you have those kind of numbers for the S&P?
For the S&P,
this correction ends. Okay.
So actually, yes, I'm looking for this correction to make a new swing low here, to clear some important orders, probably below February levels, and then I will be looking for new leg to the upside. Right. Actually, I think I have these longer term charts here.
Yeah, you've shown it accelerating through the channel, through the bullish channel, which made it, you had an Elliott channel on it, I remember. And we were, during the blow off, we accelerated through it.
On S&P?
Yeah. You know how you said, yeah, there, you know, some kind of throw over. Okay, so now it's back inside of it. It was, yeah, there you go. It's right at it.
Yes, actually, it's around there. And
nice.
and since fifth waves are extended a lot of times on stocks, especially if you check back the charts for history, you will notice that fifth waves are extended, and I will really not be surprised if we see another push to a new high here for an extended fifth wave. Even if I'm tracking fifth wave, you know, I still need to have 5 subwaves within this wave 5 before we may say that probably market is turning. So based on different indexes, I think that there is room for more upside. But as I said, again, we are in a very late stage here, I believe, and risk is very huge if you want to invest longer term.
Okay, so you want to wrap it with a couple of shorter term looks. Last week when you were on, you were looking for the potential of some kind of peak in the guppy, I recall, and we are making new highs here. So
actually, go
ahead.
I want to cover euro dollar.
Okay.
Euro dollar in combination with the dollar CAD and crude oil, and then we'll go to EURCAD, right?
Okay.
So firstly, euro dollar, we are turning from the lower side of range. I highlighted this a lot last week on Twitter. So market was actually trading to the downside. It was very slow and probably formed an ending diagonal here, right? And after worse than expected non-farm payroll support, we are turning to the upside. So now there is a chance that we will go to the upper side of the trading range. But since I'm looking for a triangle, I'm not sure if I want to take any trades within this corrective phase, because moves can be very choppy, slow, so it can be tricky price action, which I believe you don't want to be involved in with trades, right? So rather on euro dollar, maybe you should look for some other euro pairs. I'm looking for EURCAD. Why? Because crude oil actually recently came lower after a spike to a new high here, right? And we are turning to the downside. So my thinking is that crude oil is actually trapped in a consolidation here, probably in a triangle, and we see room for more weakness to make lower prices within wave C, because each leg in a triangle must be made by 3 waves. So I'm expecting more weakness on crude oil, which means that CAD could be very weak, right? And also I see dollar CAD that made only 3 waves so far, only 3 waves from the highs, right? A, B, and C. So my thinking is that we could actually, based on potential lower prices on crude oil, we could see it turn to the upside on dollar CAD. And if the euro dollar is also on the way to the upper side of the trading range, then maybe EURCAD is going to see a bounce. So
yeah, CAD could be the jet fuel of the long euro trade.
Exactly. So actually, after I saw this structure and developments on these major pairs or markets, then I said myself, okay, EURCAD should then be a very interesting pair for more upside. So actually, what I noticed is that market made a very nice deep pullback, and it made with 3 waves. It also retraced perfectly to 38.2% compared to previous extended 5-wave movement. That represents
confluence.
Yes, and also notice that wave 4 of the same degree. I'll also notice and found this useful a lot of times, that wave 4 of the same degree made similar distance in length or in pips compared to the wave 2 of the same degree. Okay, so I took this distance of wave 2, which was 570 pips, and you can see here wave 4 also the same pullback. And now we are already turning up from this very nice, interesting zone, and I'm just wondering what will happen now. We have some CAD data coming out in 12 minutes, actually. So I will watch out how market will respond, how today price action will unfold for the US session, and then if it will stay strong or maybe even higher, I will probably pull a trigger on a pullback against the lows of potential for bottom here.
Nice current example, buddy.
Yes, actually, it's a combination of everything what is going on through different assets. Actually, I'm not just looking at EURCAD, right? Like many traders do. I want to look at correlations, what other markets are doing. This is the analysis that I talked about, that we talked about earlier, right? So I was looking at the markets, I analyzed them, and after hour and a half, when I watched this, I said to myself, okay, this can be a new trading setup, right?
Yeah, the light bulb goes off after you do all that work. It's kind of like having a jigsaw puzzle, isn't it, Grega? Where you see one piece and then this fits and then that fits and the whole puzzle comes together.
Yes, actually, you don't know what will come out from this, right? When you're tracking markets, but the most important is that you don't push yourself to trading. This is probably the most important. Don't just look at the charts. Okay, I need to trade something today. I need to trade.
No,
but
make the charts push you to trade to where it's just so compelling that you would rather try it, and even if you're wrong, lose money than take the opportunity loss of being too fearful to see it after you've been patient waiting for it.
Yes, and also you will not be stressed so much if you will trade this way. So firstly, you focus and just observe the markets, what are doing, and then when you came to conclusion what can be happening, then this should be a green light for potential trigger. Another opposite.
What a great interview, Grega. I'm glad we did it this way today.
Yeah, thank you. Me too, actually.
Do you have anything else you wanted to share, or maybe show your website where people could follow you? I know they could follow your work here too. And guys, you could follow Greg on Twitter at Grega Horvat, and I'm sure most of our audience is aware of your work. But if you want to show your website, now's a good time to do it.
Yes, actually, as you know, we are covering similar markets like I do on the F.A.E. The only difference is that if our clients who are fully Elliott wave oriented, right, and want also intraday look and Elliott wave chart, Elliott wave community, we have a chat room as well. So maybe that's the better place if they love harmonics, if they like combination Elliott wave with macro, with candlesticks, with Blake's approach, for example, then maybe F.A.E. is better choice. So it's actually it's their decision.
Plus, F.A.E. has a chat room. You don't have any live room type of situation there, do you?
We have a live room for clients, yes.
Oh, okay.
Discussing about.
So if you're pure Elliott, you're not going to find a better guy, in my opinion. So, Grega, thank you very much for coming today, and I appreciate your work. I respect it, and glad to be on your team. but I'd rather have you as a friend than as an adversary. And you're my trading warrior brother.
Thank you, man. Thank you.
Okay, buddy.
Thank you for having me today for the interview.
Okay. Everyone, that's Grega Horvat. And you got to learn about his beginnings and some real macro looks and something that you'll probably be able to take advantage of in 12 minutes. So I want to thank everyone for their attention today. Thank you, Stelio. Steve Volge will be back tomorrow for Turnaround Tuesday. Everyone have a great day, okay? And remember, don't just count your pips. You got to count your blessings. Amen. See you tomorrow. You're welcome. You're welcome, Tom.